Ethan, you just want to tell me when to go to the next slide and I'll kind of navigate.
Yeah, that's fine.
All right.
Right. So, good evening, class. Tonight we'll be presenting an overview of Daniel Landau's paper, Government and Economic Growth in Less Developed Countries, an empirical study for 1960 to 1980. Next slide, please. Here's just an overview of the presentation. First, we'll be going over the background of the study. Second, explaining his data that he used in the study. Third, introduction of the study, basically where we explain why he chose to study the effect of government expenditure on development in less developed countries. Fourth, we will explain his econometric model that he used in his study. Fifth, the main results of the study. And finally, sixth, showing real-world applications of what less developed countries can do to promote growth and development. Next slide, please. The main question Landau asked is, what is the government's role in economic growth? More specifically, does the government's expenditure impact the growth rate? Why these questions are important is because to increase the standard of living in less developed countries, expenditures, that is output, must increase. And in the increase in output, better.
So wait a second. So here is in order to increase standard of living, expenditure must be increased. So this expenditure is for what? So this is a government expenditure or private expenditure or the total expenditure?
It's gonna be total expenditure. And so what he's really doing is, in some of those output models, like y is a function of c plus I plus g, what he's trying to figure out is it that simple? Is if we increase government expenditure, is our total expenditure, total output going to increase, or is there actually something else happening?
Okay.
Okay. And is the increase in output better through free markets or government expenditure and regulation of free markets? Next slide, please. This is going over the data used.
Sorry, can you just sorry? So your volume just turned down. So maybe you can.
Sorry, can you hear me?
I can, but it's very low volume.
Hello. Sorry. Hello.
Yeah, that's fine. Okay, let's continue.
Okay. Landau uses data from 65 less developed countries from 1960 to 1980. He uses data from the International Monetary Fund's publications, International Financial Statistics, and the Government Finance Yearbook, and also the World Bank's World Tables publication. And finally, he uses the United Nations Yearbook of National Accounts. All these are considered credible sources. Next slide, please. And next is just a background of why Landau chose to perform this study. It has been a trend from World War II until present that a great majority of less developed countries have chosen to substantially increase the size of their public sectors and to heavily regulate their private sectors. And as stated before, Landau wanted to study the impact of the increased size of government in these less developed countries. Also, up until this current study of government impact on growth, there really hasn't been literature on the topic. So basically, the study was the first of its kind. For the study, he uses sorry, there's feedback. Hello?
Yep, we can hear you.
Right. And the model he uses in the study is just basically a simple production function. And as we all know, simple models is usually the best when trying to generalize the real world. Output, that is per capita GDP, depends on a function that he uses for basically use the model. Output equals a function of physical capital, labor, human capital, and productivity. Next slide, please.
Yep, and then so getting into more of the specifics here. So when he thinks about, our Y variable is just our per capita economic growth over time. And so then the explanatories and the variables in the model he built are these ones as follows. So have 9 categories here. Within each category, he chooses quite a few variables to figure out the partial effects that each variable is going to have on economic growth. So as you can see,
so excuse me. So here again, so they are trying to look at these variables, how those 9 group of variables impact economic growth.
Yep, exactly.
Okay.
And so in the paper too, what he said is, because there wasn't a lot of research done, he chose about, like 50 or 60 variables and tried to measure their partial effects on per capita economic growth. We highlighted here probably the most important ones. And then if we look at this first line, this is the variable of interest, is this government expenditure. And so when he characterizes government expenditure, he's looking at government consumption. He's looking at the government expenditure on military, on education, on capital expenditure. And so when we say CapEx, you can think of large infrastructure projects. Then lastly,
sorry. So before you move to next slide, do you guys have any idea to what extent or what is the economic mechanism government expenditure can help economic growth? Have you done any research?
He's done a previous paper before this one. This is updated. He basically found that it's negative impact on government growth, or on economic growth.
Yeah, and this is also interesting at the time, because I just know, like with Keynesian economics, his whole thing is if you increase government expenditure, that's going to create a ripple effect throughout the economy. And that's what many economies did in the 60s into the 80s. Well, I mean, especially after World War II. So what he's kind of looking at is kind of contrary to what was popular at the time.
No, so actually, this is what I was looking for from you. So let me just elaborate a little bit. So actually, so the next chapter we are going to discuss is about fiscal policy. And so as you just pointed out, so back in 60 or 70, so people are thinking the government expenditure, right, so has a ripple effect, or so in economic terms we call the multiplier effect, right? So essentially, so the government expenditure have a positive impact on the demand. So that hopefully can has positive impact on economic growth. So this is one possibility. But the other thing is, so once the economy becomes developed world, so when we move along the process of growth or development, and the society becomes more and more sophisticated or complicated, and then so we need someone to coordinate. So the government is going to play a role in terms of coordinate, in terms of like resolve some conflict or just maintain some institutions, or to dealing with some externality, stuff like that. So that is the potential channel through which government expenditure can help economic growth. And furthermore, so the government expenditure may reduce inequality and provide people with social safety net, so that may encourage innovation or risk taking, right? But then, but certainly this comes at some cost, because so many government expenditure, how we are going to pay for those government expenditure, right? Just specifically look at the current affair. So this COVID-19, the U.S. government spent around 10% of the GDP, just in the middle of the year, 10% of the GDP, to trying to rescue the economy. And certainly, this government expenditure has tremendous impact on the economy. So make sure the economy can rebound, right? But this 10% of government spending come from where? Must come from tax or debt borrowing. But that eventually is going to create some distortion to the economy that may undermine economic growth. Right? So I just give you like a long answer to the question I asked.
Gotcha. And kind of along those same lines, the only other thing I want to highlight here is that the other variable he includes is transfers. So there's 2 types of transfers that he measures in his data. One is going to be foreign aid coming from like the IMF or the World Bank, and the other one's going to be private debt, private creditors from abroad. So we'll see what he thinks the effects are there. So this is just looking at his current regression results. And what I want you guys to really just see right now is that there's 4 regressions. So essentially he took his data from 1960 to 1980 and he made 4 subsamples just to see if the marginal effects of each of these variables here were consistent across time, thinking that if we're getting consistent negative or positive coefficients with a large p-value, with a small p-value or a large t-stat, then that's going to be more indicative that these results are actually true and consistent. So the first one I want you guys to see here is this government expenditure. So panel A, this is looking at current consumption expenditure across these 4 subsamples. And what you can see is that the t-stat for all of these is large and that the coefficient is negative. So essentially the way to interpret this is saying is that if the share of government expenditure increases by 1%, you can expect the growth rate of per capita economic growth to decrease by 0.234 percentage points. So, and as you can tell across our 4 subsamples, all of the, it's all statistically significant and it's negative across each regression he did. So there it looks like, you know, as government expenditure increases, our per capita growth is going to decrease at a slowing rate. And so kind of expanding on that, what I just said is, you know, as consumption, as government expenditure or government consumption increases, we're going to see growth slow. And then also he takes a look at these other 4 categories of government expenditure. And what he really finds is that it's not statistically significant. So I just summarize that as neutral, and that, you know, in some cases it looks like it could have been beneficial. Some cases looks like it could have been deleterious. There's not really a lot of evidence to go one way or the other. Interestingly, with education, you would think that the more you increase education, the higher your rate of growth would be. However, what he really sees is that on average, these governments, although they're spending in education, it's not having a large effect on enrollment rates, and therefore you're not seeing it translate to economic growth. Furthermore, for capital expenditures, he admitted in the paper that capital expenditure usually has a long time horizon where you can actually see the effects, you know, actually affect economic growth. And he just thinks the time horizon of his paper is not potentially capturing that. So that's why that variable may not have a large effect on economic growth.
So excuse me, so this consumption, can you give us an example? What type of consumption?
For government consumption, this is going to be durable goods, them getting involved in private sector markets, for example, agriculture or transportation, things like that.
Okay. So transfer, I saw this is like Social Security or Medicare, Medicaid. Is no?
Oh yeah, that is correct. Actually, you're correct, Professor. I misspoke in the previous slide. Transfer is going to be, yep, those types of transfers. He has different variables to capture the effects of foreign aid as well as private debt.
Okay.
So then he looks at, okay, so if government spending is actually making the growth rate slow, what is private spending doing? And so when you look at all these coefficients over these 4 subsamples, what you're going to see is that as private spending, as the percentage of private spending per GDP increases by 1%, you would expect to see economic growth increase by anywhere from 0.05 percentage points to 0.153 percentage points. And so what it's just saying is that there's a lot of effects that having a robust private sector could potentially spur economic growth.
But here, so I'm just curious. So did they talk about causality? Because this is because
the paper speaks about a bit about causality. They use pooled cross-sectional data.
By the way, so can you explain to the class what is the causality I was asking? Can you explain to the rest of the class? Yeah.
Yep. So in thinking of causality, he's trying to look at essentially that if private spending is either, you know, directly impacting economic growth or that's what he hopes to explain. But the other possibility is that there's simply a correlation. And so in the data, he's looking at pooled cross sections. And one of the issues of his measurement that he admits is that causality may be hard to link. This may be purely more correlatory. However, he does think, based on that he's following these countries from 1960 to 1980, he does think causality is not out of the question, but in the future, he would need to do more precise measures and getting more data.
Okay.
And so now to the foreign aid and private debt. So when you look at panel F, what you're going to see are those two highlighted boxes. And essentially what that's saying is that on those two highlighted boxes, the T-stat is significant. However, it appears that the effects depend on the measurement of the subsamples. So in a 1-year subsample, it looks like, there's a positive effect here, is that as you increase your foreign aid, your growth is going to increase. However, if you do a 4-year measurement, it looks like there's a decrease. So the author said he thinks there's a neutral effect, or he cannot essentially differentiate between the two. However, when he looks at the effect of private debt on this bottom one, you can see that the T-stat is large across the board and that it's a positive coefficient. So when private debt's issued to the economy, it looks like it's beneficial in promoting economic growth. And so then just at a high level, this is the same table you saw a few slides back, but then added a column here about the effects on economic growth. And just to highlight a few that I thought were interesting. So one of the things he saw is that if you had minerals in your country, usually that dummy variable of being yes, that actually increased your potential to grow economic growth, which would make sense. This would include oil deposits and things like that. Another thing he saw was the international economic conditions, and this is just terms of trade, the world's growth rate, things like that. He saw that in the short run, there was a positive effect in that there seemed to be some spillover effects from other countries. However, in the long run, he actually saw that there was a negative effect, and that as the world growth rate increased for developing countries, sometimes they would lag behind. He didn't have a lot of explanation for that, but I thought that was somewhat interesting. The only other thing I also want to highlight that's not on this is that in his model, he had a variable whether or not the country was a democracy. And what he found was that countries that were a democracy actually grew at a slower rate than countries that were not. And essentially what he's saying there is that for lower developing countries in the 60s, it looks like being democratic had a very high fixed cost, and that maybe they spent more resources in that than on the private market. And so early on, it looks like it wasn't beneficial to growth, which is probably a pretty contrarian idea for the time.
So, regarding to that, so I want to say a few words. Just remind yourself, so we look at this simple solo growth model. And one possible explanation for that is, so for a democratic country, so it means maybe the saving rate will be lower compared to an authoritarian regime, right? Because the authoritarian regime, maybe they have a longer planning horizon. So they care more about the growth, so that they can force everyone to save a little bit more, and that's going to translate into higher economic growth. So this actually literally happens in the Soviet Union and in China back in 1950 or 1960. So those countries or those government, they have a plan. They trying to catch up with Western country. And then particularly they have this industrial plan. They have a plan to build up their heavy industry. And so the way they do it is, so they have policy that in some sense heavily tax agriculture sector and force the entire economy to save, and then so do a lot of investment in this heavy industry, and then so naturally translate into high economic growth. That probably partially answer the interesting phenomenon they find out, and you guys pointed out.
Gotcha. Yeah, that's a good insight. It's interesting. So going forward, I guess, the key conclusions that the author really advocates is that, in his mind, from his results, not to generalize, but from this paper, he's saying that government expenditures do not increase the rate of economic growth. And his main proposal is that this could be due to the crowding out of private investment. I won't get too into that, but essentially it's just saying as the more the government spends, it's actually going to make private sector spend less just because they're going to be saving more and there's going to be less consumption. Um, the level of per capita growth is less than in developing countries. And essentially this is the opposite of what we see in the solo growth model. How they predict that because there's such little capital in developing countries, the rate of return would be larger. What he sees is actually it's smaller. And this could be because of political instability, lack of skilled labor force, things like that. Furthermore, he advocates that private investment is going to be an increase to the rate of economic growth. And then lastly, foreign aid is not going to increase the rate of economic growth, and private debt, in his mind, will increase the rate of economic growth. So, as we think about these key conclusions and what this paper is saying, like the question then becomes, how do you apply this to the real world? Or if you were advising developing countries' governments, what would you do based on this paper? And so based on what he says is he takes a very neoclassical approach as opposed to a Keynesian's approach, where he thinks governments shouldn't be the ones playing in the game. They should just be the ones providing the institutions and the rules to the game. Instead, they should be spending all of their time, not all of their time, but a large amount of their time, stimulating conditions for private sector growth. Furthermore, instead of focusing on the savings and on investment, over time, it's a lot of research has shown that actually having that planned state of mind doesn't always work out, like the Soviet Union or some developing countries. Whereas instead they should focus on technology that has a greater effect than capital. So again, focusing on those incentives as opposed to the investment rate. Lastly, he sees that foreign aid does not increase economic growth. So, institutions like the IMF or WHO, they might want to focus more on giving foreign aid to families and businesses directly as opposed to going through the government. Because as we know, governments in lower income countries can be more corrupt. So, about microfinancing and things like that. Lastly, in terms of that private debt, a thing that can be more helpful for these lower income countries is by increasing the term length of private debt. In the 80s and the 90s, a lot of private debt was short term, and that was one of the causes of various crises, is that once there was a little bit of scare, creditors could just pull out their money very quickly. Whereas if you increase the length of this private debt, say to 10 years, to 20 years, they have to have more skin in the game and they have to stick it out, where it's going to create more stability in that country. So yeah, that's our overview of our paper. Some pretty interesting results that kind of are contrary to economic theory at the time. You guys have any questions at all?
I have a quick question for you, Jimmy.
Yep.
You said the paper was written in 1986, right?
Yep, that's correct.
All right. So like around the 1980s, that's right around the time a lot of countries started to move away from the traditional Keynesian economics, especially starting with the US. Does he talk about that at all in his paper? And do you think his paper had an effect on that?
Yeah, that's a good question. Honestly, he really does not bring up Keynesian economics that much at all. When he starts off the paper, he kind of just pays homage to Adam Smith and the free markets. But he doesn't really apply it directly to specifics of different countries. It's very much more theoretical, I would say.
So that's a very interesting point. So, but to my best understanding, yes, there was a big discussion in academia, but in practice, or if we think about in the arena of political decision making, I think people still relies on Keynesian or new Keynesian stuff in terms of policy making, even though there was big discussion. Like in 1980, there was a rational expectation revolution. But in terms of actual policy making, they still relies on those Keynesian stuff. Even today, right? Just think about, so we are in the COVID-19 pandemic. So look around the world. So I think people still are following the idea of Keynesian or new Keynesian. Keynesian or new Keynesian stuff.
Yeah, and I guess even to add to that, even currently with interest rates so low. I know new Keynesian ideas are kind of making their way back into.
Yeah, but I guess probably the fair way to say that is, in the short term, or Keynesian series is more for like short-term fluctuation. And if we looking for long-term growth, and then so you probably need to realize like your first point made very clear, you need to realize a strong institution, or you need to find something can fundamentally change how we structure our economy. But for Keynesian is more a policy to dealing with short-term fluctuation. Like say, because right now we all have a COVID-19, and so yes, this COVID-19 can or will have permanent impact on the way we run our business, or the way we do business, or our economic behavior. But so in some sense, or in large extent, so this COVID-19 is a transitory shock, right? So when I say transitory shock, it just says, okay, so this virus eventually is going to go away, and eventually we're going to find a vaccine. This is not going to stay here for like 10 years, or like back in mid-age. So these bacteria can stay with us for centuries, come and go and come and go. This is not the case. Does that make sense?
Mm-hmm. Yeah, it does.
Yeah. So yeah, I guess just Keynesian stuff is more like a short-term fluctuation, not for like a long-run growth. And the basic here, I believe, so these authors was trying to advocate in. So in terms of long-run growth, we really need to look at those factors can fundamentally change how we structure our economy. But I guess they just believe, okay, so just if we look at superficially, look at government spending, and or so maybe just a large part of this government spending was designed to stabilize the economy, and with no doubt that won't have much long-term impact. I get that's the way to understand. The other interesting things to point out is so foreign aid versus private debt. So that in some sense that just also just linked to the first thing, or the things we just discussed. So ideally we need something can change the incentive or change how we do business, instead of just giving the aid. And as I just mentioned, like loss clause, and then you guys already mentioned that very clearly. So this foreign aid may backfire, or may just collude with those corruption in less developing country, right? So thank you so much for your presentation. Is that all you have?
Yep, that's all we have.
Okay, very good. Good presentation. Send me your slides, okay, so that I have a record. So okay, so we have two more. We have only one more.
We have two
Who
more
else is going to
groups.
present? Huh?
Two more groups.
Two more groups. So why don't we take like 10 minutes break, and then so who wants to present first? Share your screen. Huh?
We can go next.
Okay, so let's come back at 7:10, all right?
Okay.
Okay.